And so in summary, California AB-150 is good for most Californians, being how expensive the real estate is here. We pay a lot of real estate taxes, and then it's expensive to live in California, so you're probably paying high income taxes as well. That being said, analysis is necessary to fully make the recommendation, but at the end of the day, AB-150 effectively allows you to write off your California personal income tax as a business deduction, and that's a good thing. California's pass-through entity elective tax was signed into law in 2021 on California Assembly Bill 150 and creates an optional 9.3% entity-level tax that's calculated on the entity's California net income for tax purposes. In turn, this creates a dollar-for-dollar, non-refundable California individual tax credit for the entity's owners. And this is coming as a response to the Federal Tax Cuts and Jobs Act of 2017 that created a SALT cap of $10,000, leaving most Californians without the ability to write off their state taxes. From the business's perspective, this is a deductible business expense, ordinary and necessary, and something that you wouldn't be able to write off otherwise. And then from California's perspective, this payment is a tax credit that flows through to your individual tax return and is non-refundable. Okay, so if you participated in AB 150 last year, what you're going to want to do is you're going to want to pay at least 50% of that amount, that PTET amount, by June 15th of the current year. That's going to make it so that you can participate this year. If you do not make that payment by June 15th, then you are ineligible to participate in the current year. And then you would have to pay the remainder with the tax return, which is typically due March 15th of the following year. And if you did not participate in AB 150 in the prior year, you just have to send $1,000 before June 15th in order to hold your spot for this year. And then again, you're required to pay the rest with the tax return, which is typically due in March. Now, that being said, we do recommend that you make that second payment and pay in full in the current year so that you could write it off this year. Most business owners are cash basis. Most small business owners are cash basis. And so you actually have to execute that payment in the current year if you want to take it as a deduction this year. So is this strategy right for you? Well, the best fits for this strategy are people who either itemize on the Schedule A, and if you look at their line 5 state and local taxes, it exceeds $10,000, or they take the standard deduction, because in both cases you're getting no federal benefit for paying state tax and you're essentially paying double tax. Also, you should probably take a look at the California side, and it's best that if you go to Form 540, line 34, that amount, the total tax, is actually less than the pass-through elective tax that you've paid at the entity level, because that means you'll get to use the entire credit in the current year. That being said, any unused portion does carry forward for 5 years, so the excess amount is not lost. As a business deduction, the estimated tax savings are determined by, first off, figuring out what your effective deduction is after the qualified business income deduction, or QBID for short, and then you multiply that by your marginal tax bracket. Also, it is an individual tax credit on the California side, so it has a zero negative cash flow impact for implementing this strategy. And furthermore, the tax savings themselves generate a positive cash flow. And so in summary, California AB 150 is good for most Californians, being how expensive the real estate is here. We pay a lot of real estate taxes, and then it's expensive to live in California, so you're probably paying high income taxes as well. That being said, analysis is necessary to fully make the recommendation, but at the end of the day, AB 150 effectively allows you to write off your California personal income tax as a business deduction, and that's a good thing. This presentation was created to support our comprehensive tax planning service, where we curate strategies to assist taxpayers in reducing their tax liability. We do this by analyzing their business, real estate, and individual activities and determining the optimal structure, optimal accounting method, available tax deductions, and available tax credits. Then we prepare a summary of estimated tax savings and effect on global cash flow to assist our clients in determining which strategies to pursue. Finally, we coordinate the action items needed to actually achieve these savings. If you're interested in learning more, please schedule a call with us. Current clients, please reach out to your partner or accountant, and all others can call our office to schedule an intro call.